is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, standing in for Francine Lacqua. Here's what's coming up on today's program. Risk off across global markets, stocks slide and treasury yields drop amid growth and virus concerns. Blindsided, Senator Joe Manchin delivers a potentially fatal blow to President Biden's $2 trillion spending plan. Plus, more restrictions. The UK doesn't rule out more curbs before Christmas, and the Netherlands goes into lockdown. Well, good morning. Happy Monday to you. And it's an ugly start to the week. It's not just Joe Manchin threatening the Build Back Better bill. It's also Goldman Sachs downgrading their outlook. And all of that comes, as Ben Amons over at Medley Global Advisor comes, at an untimely point in this market, considering we're getting growing cases of COVID. So it means that not just U.S. equities are impacted, we're seeing the impact across global markets. We're looking at a Euro Stoxx 600 that's down more than 2%. All of that means despite a more hawkish Fed, despite what you'd assume to be tighter global policy, we're looking at a U.S. 10-year yield that has money flying into it. That means yields lower by 3.5% so far this morning. Also stands to reason that we'd see crude sell-off. Again, the concern here is demand. Rising COVID cases means there's less mobility. You're having factories potentially shutting down as well. So you're looking at Brent crude down nearly 5%. And finally, the lira, an asset we've had our eye on all month. President Erdogan on Sunday saying he's recommitting to that idea of aggressively cutting interest rates, saying that he's sticking with the principles of Islam in doing so. So here is your map markets go. Again, it is a very red day. You'll be hard-pressed to find anything that isn't falling more than 2%. DAX is almost down 3%. You're looking at a CAC Rolling that's down 2.3%. The UK stock's down 2%, maybe a little bit of a help from a softer pound, but still not saving it from these severe declines we're seeing across the board in Europe. Again, it is this whipsaw of markets that continues into year end. It is not really looking like we're going to get that Santa Claus rally that many had hoped for. So here's what it looks like when you break it down by the various sectors. Travel and leisure, again, this is COVID concerns. This is fear of more shutdowns. Germany the economic advisor talking about possibly putting more restrictions into nightclubs. We're also looking at autos as well. Again, this is a high beta sector, so it makes sense that this is falling down. And some corporate news here as well. We have Novo Nordisk falling the worst performer in the Stoxx 600, down more than 11%. Manufacturing problems, saying that those will significantly impact the U.S. launch of its blockbuster obesity drug called Wegovy. We've seen both Citi and J.P. Morgan downgrade the stock to neutral. Finally, a semi up there for you, BE Semiconductors. More production problems for them as well, cutting its revenue view because of a flooding at a production facility in Malaysia, saying that their fourth quarter revenue could decline by about 15 to 20%. So those are your movers. But again, our top story today remains President Joe Biden and his economic agenda that appears to be up in the air. Democratic Senator Joe Manchin rejected his key $2 trillion spending package. Manchin says he's opposed to the fact that the bill would add to the U.S.'s already large debt burden.
If I can't go home and explain it to the people of West Virginia, I can't vote for it. And I cannot vote to continue with this piece of legislation. I just can't. This is a no on this legislation.
Joining us now is Lena Komileva, G+ economic chief economist. As well, we also have joining us Christine Aquino from our Bloomberg team. Christine, let's start with you. Walk us through sort of the market impact, because it's not just U.S. equities that are being impacted by this. If this was a pure U.S. story, it's really risk assets across the board.
Absolutely, Danny. I think we're seeing very much this risk-off tone across stocks, bonds, and currencies alike. As you mentioned earlier, Treasuries definitely the favorite haven today as we head into the start of this week. And we're seeing it across currencies as well. You know, your favorite havens there, the yen, the dollar outperforming the rest of the complex and exacerbating some of those declines that were already in play, particularly in things like the Turkish lira. And of course, in stocks, if you look at the sector level as well, we're seeing very much those sectors are very sensitive to risk risk sentiment and changes in that, and anything related to mobility and anything that's sensitive to lockdowns, very much all down today. And I think this is very much a concerted effect on markets, both from Omicron worries as well as concerns over growth now that we're seeing some negative headlines coming out of DC.
Right, that growth concern, Lena, let's bring you into this. We had Goldman Sachs cutting their first quarter U.S. GDP outlook by 50%. Are you having to evaluate as well the U.S. economic growth picture, given we might not have the Build Back Better bill?
I think so. I think that the key concern at the moment is that whilst the focus has been on inflation, I think for me the big picture and the big theme for early 2022 is, in fact, a policy-induced major business cycle slowdown. That slowdown is going to get exacerbated. And if there's one lesson that I learned back from the 2007-2008 financial crisis, is that inflation tends to drop off quite rapidly from top-line figures, top-line news, if you like, at the minute that we have tighter financial conditions and a parallel growth slowdown. And I think this is what we're heading for in the early part of next year.
Just how short could this economic cycle be, Lena, given all of that?
I think this is it. I think market focus is pivoting towards the sustainability of this cycle. What we have had is the fastest recovery on record, and it's happening against a backdrop of inflation, higher than we have had for a decade at least. And that means that, in a sense, the operational framework for central banks that we had presumed as a given, that the regime of lower volatility and lower rates forever is no longer in play. And what we also have in the short term is that negative momentum, the perfect storm, if you like, of the parallel Delta and Omicron waves, creating that risk of broad-based slowdowns, lockdowns, as well as that policy-induced slowdown that will shift towards negative fiscal multipliers in the context of sharply tighter financial conditions. And the uncertainty that we are, in fact, much closer to the end of this cycle than markets had assumed earlier. There's no way of knowing, but what we do know is we step into the river of the unknown of 2022, is that things are nothing like what we had expected even a month ago. And that in itself is a knock for market confidence.
It is pretty remarkable. I mean, we're seeing Brent crude sliding more than 5% at this moment. Christine, to Lena's point, it's this uncertainty which is gripping markets at this moment. And for what it's worth, the bond market not necessarily telling us that the Fed will be able to be as hawkish as they perhaps are projecting.
Absolutely, Danny. I think that was one of the most notable observations from last week, is that even after we got the indication from Jay Powell that the Fed was ready to raise rates 3 times in 2022, the markets really were not buying into that. And I think this is very much reflective of what we're seeing as the main market fears heading into 2022. As Lena said, I think it is very much this fear of a policy mistake of some sort that would lead to policymakers tightening policy too much, that it actually is hurtful for long-term growth prospects. And now that we're getting these negative headlines in relation to growth, in relation to Omicron heading into 2022, those fears are very much front and center. And that's where we're seeing this sort of market reaction today.
Christine, thank you very much. That's our Christine Aquino. Thanks so much for joining us. Also with us is Lena Komileva. She's going to stick around, of G+ Economics chief economist. Now, coming up, Omicron spreads, the Netherlands locks down, and we'll be talking COVID and Christmas with Sam Fazeli from our Bloomberg intelligence team. This is Bloomberg.
I don't foresee the kind of lockdowns that we've seen before, but I certainly see the potential for stress on our hospital system.
That was Anthony Fauci on the pressures from the Omicron variant. Now, the Netherlands has gone into lockdown, closing schools and non-essential shops and limiting the number of household visitors. Here in the UK, the health secretary is refusing to rule out stronger restrictions before Christmas, to contain sharply rising infections. Joining us now, I believe we have Sam Vazeli from our Bloomberg intelligence team. So we have all of these restrictions, Sam, increasing. I wonder if we view these as getting to the same extent perhaps that they were last Christmas, or if we should be expecting a less severe type restriction global environment right now.
Hi, good morning. I think one of the biggest and most difficult decisions for any government to be making again is having asked their populations who have mostly complied to have vaccinations, to have a third dose, having been through 3 waves, is to go to another lockdown. However, the decision has to be based on what's happening with the healthcare system. You cannot have a healthcare system that collapses. And there's 2 problems here. One is, even if Omicron is causing less severe disease because people are vaccinated and immune, you still have a problem with the magnitude of cases, meaning that there'll still be a lot of demand on hospitals. But at the same time, given how infectious it is, the risk is that you lose a large majority of your healthcare workers to the infection and the 10-day mandatory isolation. And that's the 2 connected issues that I think we have to think about. And that will be the decider for which countries do eventually put in a circuit breaker or not.
Right. I mean, look, it's definitely a lot of unknowns to weigh up at this moment. Lena Komileva from G+ Economics is still with us as well. And Lena, I want to bring you into this conversation. I mean, Sam is talking about a lot of different factors that could impact the type of restrictions we get when we get them. How do you model this? Is this just a complete, unknown heading into 2022?
That is a great question. I mean, from a macroeconomic perspective, it is clear that COVID is a major demand shock in the short term. But to me, really, this has been a series of supply shocks. So whilst we are going to have a great deal of pain and hardship in the short term, there's no question about this. We can expect that once this wave is over, that will be recovered in terms of growth pretty rapidly, especially because we still have a lot of accommodation, fiscal and monetary, in the system. Having said this, we are, of course, in the midst of a dual Delta and Omicron wave across major economies. 275 million people, according to the World Health Organization, have suffered so far in this pandemic. 5 million lives have perished. We're nowhere near the end of that. What I'm hoping for, it's impossible to know in advance, but what I'm hoping for is that we are better prepared in terms of recovery rates than we were this time last year, not just in terms of the global vaccination rates, but also in terms of the medication that can help people recover faster. If we combine that with the fact that most likely, given the high transmissibility of Omicron, we are going to end up with levels of immunity in the population much higher after this wave than after previous waves. And I don't mean just antibodies, I mean T cells, the immune cells that target and destroy the virus in the body.
Lena,
perhaps we're looking at a more sustained recovery, that transition to endemic.
Lena, sorry for jumping in there, but I do want to pick up on a point you mentioned and take it to Sam. And you say, the hope is that we're more prepared to battle this wave. Sam, are we more prepared?
Well, some countries are. Unfortunately, as we all know, the vaccine distribution around the globe has not been equitable. So there are several countries which have a major headache that they're heading towards. The issue is looking at this combination of previous infection and vaccination, giving you that wall of immunity. So you don't know how much previous infection provides immunity. South Africa tells us that perhaps it's not that is quite good. But the other question is, if you then sum that number up, what do you get for different countries? And unfortunately, of the developed nations, the United States is lacking, which is one of the biggest economies the biggest economy in the world. So that's the issue in the developed world. That's the issue that we have to think about. What does this mean for the US? And of course, Europe, across Europe, there are also disparities.
Lena, one of the interesting things and rather unfortunate things that's emerged from this is, as Sam was describing, the disparity between different countries. And that disparity also, of course, extends to central bank action. You have China that's looking at easing policy versus a US, a UK that's looking at tightening policy. What does that mean for how you factor in global growth, the divergence of these various economies?
I think that this is such an important question because the assumption that we had at the start of the pandemic, that this is a pandemic we can ride off the back of a very strong policy safety net, that is a socialization of costs associated with economic growth that's then publicly financed through the balance sheet of central banks. I mean, that narrative is being rapidly unwritten at the moment. In fact, we're well into this wave of the next global, of Omicron, with the firm expectation of fiscal multipliers turning negative and central banks rolling back rolling back stimulus quite rapidly in the early part of next year. But that expectation is already in the market. So in a sense, the financial tightening that we expected is already being priced in as we speak. I think the key concern for me here is that this is very different from the regime that we've had in the markets for the last 18 months, in the last decade, for that matter. And that means that we have more growth, more inflation, and more policy and more liquidity risk injected into financial portfolios. What does that mean? Less accommodation. I think that the Goldilocks scenario that we assume in terms of GDP growth forecasts and an excessive demand and inflation, excessive demand over supply going forward is simply far too complacent.
All right, Lena, thanks so much. Unfortunately, we're out of time. So fantastic to have you on the program with us. Lena Komileva, G+ Economics Chief Economist, and Sam Vazeli from Bloomberg Intelligence. Thank you both so much for joining this morning. Now, coming up, more rate cuts. President Erdogan pledges to act further, tying his unconventional monetary policy to Islamic teachings. We're going to have more on that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, the Turkish lira has weakened to a new low after new comments from President Erdogan yesterday. He pledged to cut interest rates and tied his policy to Islamic teachings. Bloomberg's Simin Demirkan joins us now from Istanbul. So, Simin, set the scene for us. You have Erdogan's pledging to continue interest rate cuts, and it's made the lira the worst performing currency over the past 3 months.
That's right. The sell-off in the lira continues as Turkish president says he will continue cutting rates. He says that Islam demands low rates, and as does he. The Turkish lira hitting record lows against the dollar, currently down more than 6% and at 17.5 per dollar. Over the past 3 months, the lira is the worst performer amid world currencies, and it's lost almost half of its value. President Erdogan's economic policy is lower rates in order to transform Turkey into an export-driven economy. And he says he will not back down from this. He says even though that we're seeing a collapse in the lira, this is due to an economic siege, and he will continue with his economic policy of low rates.
Well, let's dig into that a bit more because, of course, we have central banks around the world talking of rate hikes in the face of inflation, and Turkey is doing the exact opposite. Why?
That's right. I mean, President Erdogan demanding lower rates. He has an unorthodox view that high interest rates actually spurs inflation rather than prevents it. Of course, most economists around the world would disagree with this view. Last week, the Turkish central bank cut rates once again. Since the easing cycle began in September, it's cut by 500 basis points, and the main benchmark rate is currently at 14%. Now, last week, central bank Governor Sharp Kavcıoğlu actually implied that there will be a pause in rate cuts. However, investors say that they don't trust the central bank anymore. And of course, President Erdogan saying rate cuts will continue.
Simin, is President Erdogan's waning popularity due to his handling of the economy?
Yeah, President Erdogan's popularity is near record lows. Voters are, of course, concerned about inflation, which is above 21%, and also high unemployment. They're also seeing an erosion in their purchasing power and their savings as we see a slump in the lira. Some business groups are also saying that this weakening of the lira will damage both production and investments. And we have opposition opposition parties actually calling for early elections that are scheduled for 2023. President Erdogan saying early elections won't happen.
All right, Simon, thank you so much, as always, for staying on top of this for us. That's Bloomberg's Simone Dimikan in Istanbul. I quickly want to bring to our attention a tweet from Schnabel, of course, from the ECB, congratulating the new pick of the head of the Bundesbank. That's Nagel, of course, saying congratulations for being nominated as the new president. This, of course, comes after Jens Weidmann had stepped down. There's some disagreement over the path of inflation. So Nagel, 55, who is going to be succeeding him, and he had been, Schnabel, of course, Isabel Schnabel had been a possible policymaker who had also been seen as a potential candidate for the job as well. So we'll keep an eye on that for you. Now, coming up, can Joe Biden push through his $2 trillion economic package? We assess the mounting political risks facing his administration with Leslie Vinjamuri, head of the U.S. and America's program at Chatham House. That's next. This is Bloomberg. Risk off across global markets, stocks slide, and Treasury yields drop amid growth and virus concerns. Blindsided, Senator Joe Manchin delivers a potentially fatal blow to President Biden's $2 trillion spending plan. Plus, more restrictions. The UK doesn't rule out more curbs before Christmas, and the Netherlands goes into lockdown. Good morning. Happy Monday to you, and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, standing in for Francine Lacqua. So here's where your markets stand as of this Monday morning, 9:30 in London, and it is an ugly picture. We're looking at declines of nearly 2.5% for the Euro Stock 600, really kicked off by Manchin saying that he wouldn't support, as it currently is, the Build Back Better bill, and Goldman Sachs downgrading their outlook for U.S. economic growth. Of course, this comes at a time when we're seeing rising virus cases, so that really has had a ripple effect across global markets. You're seeing demand when it comes to yields. You're also looking at a lira falling to an all-time low as Erdogan pledges more cuts. Looking into the map here, this is Map Markets Go on your terminal. It's all red. It's all declines of 2% or more. Not many sectors, not many countries are immune here. One that's maybe outperforming just a touch is the UK. It's down 2% versus, let's say, 3% nearly for the DAX. Really just likely has to do with a pound that's falling by about 0.5% by the US dollar. So that's helping that country a little bit more, those currency effects. But still, when we dig through the sectors, it's these higher beta ones and these really exposed to global demand, to travel, to restrictions that are taking the biggest hit. You see travel and leisure, the worst performing sector, down 3.5%. And some autos also down more than 3% as well. Again, one of those higher beta sectors that's usually suffers on those risk-off days. Also looking at Novo Nordisk, some issues when it comes to production and launching their U.S. version of their Wegovy drug. It's an obesity drug. And also BE Semiconductor, another issue of production here. A flood in one of their Malaysia factories means that there is much disruption there. But of course, Novo Nordisk at a nearly 11% decline is the worst performer. So back to our top story today, with President Biden under growing political pressure, and that's after Senator Joe Manchin, a Democrat, said on Sunday that he would not be voting for Biden's economic revival package. Here's a reminder of what he said.
If I can't go home and explain it to the people of West Virginia, I can't vote for it. And I cannot vote to continue with this piece of legislation. I just can't. This is a no on this legislation.
We're joined now by Leslie Vinjamuri, head of the U.S. and the Americas program at Chatham House. Leslie, thanks so much for joining us this morning. Certainly a lot for us to walk through, but let's start there with Joe Manchin's comments. How much of a fatal blow is this for the Build Back Better bill?
Oh, I think it's a very significant blow. And remember that it was really not anticipated by the White House. Joe Manchin had led them to believe that they had gotten to a compromise that he would back. They've been in very, very close, ongoing, careful conversations for a long time now. So I think this is really not expected. As we saw from the press secretary's comments, the reaction has been very intense.
Well, speaking of the reaction, I mean, it was pretty stark because we had seen a White House that had been pretty deferential to Manchin, considering how important he is to the passage. Jen Psaki, the White House press secretary, her comment, she specifically said, called it a sudden and inexplicable reversal in his position, a breach of his commitments to the president and the senators' colleagues in the House and Senate. Given that, I mean, very strong tone and perhaps different tone coming from the White House, what does that tell us about the path forward for more negotiations?
Well, we did see that, President Biden is keeping the line open, much to his credit. I think that the White House and certainly the Democratic Party understand, as do the American public, how much power the senator holds just by virtue of the split in the Senate. And so it's a very difficult position for the president to be in. Remember, he's under tremendous pressure from Omicron, from the pandemic, from rising inflation, and globally, the concern over Russia and Ukraine. But this is really the core of what he wants to deliver, to transform the American economy, to invest in climate change. Remember, climate is absolutely centrally features in this bill, which is certainly part of why Joe Manchin hasn't been on board. So I think as we look ahead, one question will be whether there's any potential to break down that bill into smaller parts and possibly get some Republican support behind certain elements that they have actually backed. The child tax credit is one, but it could come at a very significant cost again to that part of the bill, which seeks to put the president's climate agenda forward, getting America to hit its targets. But any of these negotiations are going to be very fraught. They will call on the Democratic Party to get behind a bill that they won't like if it's pared down significantly. We know how difficult it was just within between the progressives and the moderates to get to this position, even without Joe Manchin as a factor. So I think the path ahead is very difficult, but undoubtedly it will be pared down into a series of smaller bills.
What does that mean, more politically speaking, for Biden, for the Democratic Party and their appeals as we head towards more elections, considering also that Biden, to a large degree, said, I'm coming in and I'm a master Senate negotiator?
Well, I think that it's difficult. The president has not had strong approval ratings, largely, I would imagine, because of the economy, because of that concern over inflation, and because the pandemic isn't over. But he can point to certain successes. Clearly, infrastructure was supported by Republicans as well as Democrats. But this is tough because this really was his signature legislation. It's not coming through. And as we move into 2022 and all eyes are on the midterm elections, the Republicans, of course, can run with this. I think it also makes it difficult to see a failed legislation that many moderate Democrats supported that perhaps some of their constituents wouldn't have. So it's politically a very difficult position for the Democratic Party to be in. That was always going to be the case. This makes it much harder. But there's also a question, about what comes next, because Joe Manchin's vote will continue to be important in the Senate, absolutely critical. So the party is going to have to try and pull him in and try to understand what motivates the senator.
Well, what could that timeline look like, considering we've already had lawmakers leave for the holiday season? Do we have any idea of when they could ramp up again?
I think that the White House will be working this very hard immediately. First thing, I certainly was already doing that yesterday. We'll be trying again this morning. But as you said, it's a very short window before the holiday. And this is a president who is undoubtedly going to have to be thinking very hard about his response to the spread of the Omicron variant. So multiple pressures and in a very short timeline.
On that note of the spread of the Omicron, it naturally leads people to say, okay, if there are potentially more restrictions in the U.S., more stimulus, perhaps, fiscal stimulus coming from the U.S., but having Joe Manchin saying that his issue with the Build Back Better is this debt pile that's accruing in the U.S., does that necessarily then rule out more stimulus coming from the U.S. government in order to combat some of the economic issues that arise from an Omicron spread?
Not necessarily. Remember, this is a senator that has deep motivations that are linked to the state that he's leading from. He's clearly not an advocate of climate change. There are many things in that bill that he was never supportive of. Doesn't necessarily mean that his vote on subsequent measures is predetermined. And in fact, he's now sort of signaled to his own state that he's walking the walk that he's promised, and it gives him arguably more freedom to compromise on smaller, more discrete measures in the future.
All right, Leslie, thank you so much. Really perfect day to have you on. That's Leslie Vinjamuri, head of the U.S. and Americas program at Chatham House. Thanks again for joining us. Now, coming up, global deal making is in the middle of a historic boom, with volume set to top $5 trillion for the first time ever. We'll dig into what's been a record year for deals and look ahead to next year. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, global deal making is in the middle of a historic boom, with volume set to top $5 trillion for the first time ever. That's the highest level of M&A since right before the financial crash in 2007. Here to wrap up all the 2021 action is senior UK correspondent for deals and deputy bureau chief Ruth David. Ruth, what's driving this record pace of deal making this year, and can it continue?
Hi, Danny. When you see a $16 billion deal get announced in the week of Christmas, you know that it's a year that is like no other, right? We think that we're going to top $5 trillion this week. And some of the things that have been driving it are what you see in today's deal, where Canada's BMO bought BNP Paribas' US business. You're seeing companies and CEOs go ahead and do their biggest transactions because stock market valuations are really high. Investors are keen for them to do the kind of big transactions. We started off this year with Couche-Tard from Canada making a play for Carrefour, but that is one of the risk factors in deal making, right? Governments are taking a closer look at transactions. The French said Carrefour was strategic, expectedly, but you're seeing the Biden administration taking a closer look at M&A. You're seeing the UK scrutinizing it more, and you're seeing the interest rate circle, which kind of was helping companies do deals, very low interest rates. You're seeing a time when maybe that does not continue. So sure, we've got to $5 trillion this year, and there's still a lot of money sloshing around in the markets. You've got private equity buyers in there as well. But whether that continues into next year remains to be seen. The one thing that we do think will keep happening is companies focusing on their core. So GSK today said they're going to list their consumer business. We've seen J&J, we've seen GE in the US announce that they're splitting up, that they're selling off what they don't think is as core anymore, so that they can be leaner, meaner machines to deal with whatever the next years may bring.
And that also brings to mind action from activist investors who often push companies to do these sorts of things. To what degree have activist investors been influencing the deal making?
Absolutely. And, you know, we've seen Elliott really strongly in GSK. We saw Bluebell in Danone pushing for change, something which you never thought would happen, but they managed to get that change done. I think the activists that we've been talking about in Europe for years now are finally here to stay. They're making bigger and bolder moves. We're seeing them in Asia. They've of course always been in the US. And with the amount of churn, with the amount of challenges that are facing companies, including an increasing focus on ESG, there's likely to be a lot more of that going forward.
All right, Ruth, thank you very much. Actually, before I let you go, I do want to ask one more question. I know we talked about it a little bit this morning, but what do you make of Spac and IPO volume? Because that had obviously gone gangbusters over the past year as well. Is that something that's likely to continue?
Well, as I said, one of my sources said his dog could do a Spac in the boom time this year. Maybe not as crazy a market, because bankers and billionaires are finding it hard to get things to buy when they list their Spacs. And you're seeing more SEC scrutiny on it. But Europe is now catching up to the US, so there are likely to be more of these SPACs coming out. It remains to be seen how they can get these deals done. And if you're looking at the IPO markets, which have had a record-breaking year as well, but not performed so much, maybe take a look at Deliveroo or Bumble's IPOs and where they're trading before you think of putting in a lot of your money into stock listings.
Ruth, if that isn't the deals quote of 2021, then I don't know what is. Thanks so much for joining us as always. That's our Bloomberg senior UK correspondent for deals and Deputy Bureau Chief Ruth David. Now let's get to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Danny. Bloomberg understands Germany's new coalition government has picked Joachim Nagel, a former Bundesbank senior official, as the central bank's next chief. He will succeed Jens Weidmann, who leaves at the end of the year. The choice of a Bundesbank veteran suggests consistency rather than a change at the institution. Now, Elon Musk says he will pay more than $11 billion in taxes this year in what could be a record payment to the U.S. Internal Revenue Service. The levy comes after Musk exercised almost 15 million options and sold shares to cover the tax related to those transactions. The world's richest man has been reducing his stake in the electric car maker after the results of a Twitter poll on a sell down. Now, Blackstone is nearing a deal to acquire luxury apartment rentals in downtown Manhattan, the firm's latest wager on New York real estate. Bloomberg has learned the property giant is in advanced talks to acquire a residential tower for $930 million from Brookfield Asset Management and Nuveen. It is the latest in a series of recent bets on the staying power of high-end New York buildings. And Walt Disney has reached an agreement to keep its program on Google's YouTube TV service after an existing pact expired last week. The deal restores access to content from ESPN and other networks. TV networks are becoming increasingly reliant on fees from distributors as consumers cancel cable TV packages in favor of cheaper streaming platforms. And that's your Bloomberg Business Flash. Danny.
Leanne, thanks so much. Leanne Gerrans there in London. Now, coming up, the UK government hasn't ruled out COVID curbs before Christmas. It also has a new Brexit negotiator in Liz Truss following a shock resignation from Lord Frost. We're going to talk about pandemic and politics. This is Bloomberg.
The ET5 is a key product for us as NIO has long focused on SUVs. We've been looking forward to a model with a more suitable price and a larger consumer base. All of NIO's latest autonomous driving technology will be available in the ET5.
Global chip shortage and global supply chain disruption have been impacting a lot of industries, including EV sector, because EV use a lot of chips. So how has that affected your production? How will that affect the rollout of new products for NIO next year?
It is indeed a big challenge. Our deliveries in August and October were affected by the chip shortage. In fact, our supply chain team needs to carefully communicate each chip component's delivery time with our partners every day. Of course, we are seeing some good signs. Starting next year, some chip companies will increase the capacity of car chips, which I think will be released around the middle of next year or in the third quarter. There's no doubt that COVID-19 has made our production more complex. Even the shortage of one single chip of the over 1,000 units equipped on our car may affect the production.
So Chinese stocks listed in the US have been affected by a lot of issues lately, including the delisting of DD recently, right? So NIO, as a US listed company, do you have any plan to shift your listing to Hong Kong, following the footsteps of XPeng and Li Auto, for example?
We hope political issues won't affect much of a company's growth, and we for sure will abide by the local laws and regulations.
Are you considering to list yourself in Hong Kong one day?
I think anything is possible.
So you've mentioned NIO would enter 25 countries by 2025.
Yeah.
Could you give us a bit more details? When, for example, when do you plan to sell your cars to the US market?
NIO 就在圣何塞。
NIO has set up a research department in San Jose in 2015 with hundreds of staff to develop our global products. We started seriously considering entering the North American market since 2017 by making our products and services more competitive. Of course, we are still working on the plan. We will enter Germany, Sweden, Denmark, and the Netherlands next year, and more European countries in the following year. Our international market entry strategy has always been making long-term plans and staying patient.
NIO CEO William Li there speaking to Bloomberg. I want to bring us some breaking lines just crossing the terminal over the next president of the Bundesbank. We have the German finance minister, that's of course Christian Lindner, confirming that the new pick to head up the Bundesbank is Joachim Nagel. Of course, this is something that we had seen Isabel Schnabel congratulate on Twitter, so this had been assumed. For what it's worth, Nagel really represents a continuity of when it comes to the leadership of the Bundesbank. Now, let's change focus and on the pandemic here in the UK specifically, and the health secretary is refusing to rule out stronger restrictions before Christmas to contain sharply rising infections. Joining us now is Bloomberg's UK reporter Lizzie Burden. Lizzie, is it possible that new COVID restrictions could stop Britons from going home for Christmas?
Well, yes, the government's own scientific advisors have said that it needs to implement tougher new rules, including stopping households mixing. So in other words, stopping Christmas, if it's to prevent hospitalizations related to COVID tipping past 3,000 a day, which was what would overwhelm the National Health Service. But you've already got businesses crying out for more support from the Treasury in the UK, and a third of the cabinet is said to be against the new restrictions. So Boris Johnson, the Prime Minister, may not want to risk the political embarrassment of putting that vote past Parliament. His authority's already been waning in recent weeks. He suffered that record mutiny the last time he tried to get COVID restrictions through Parliament, and the humiliating defeat in that local by-election recently. So it'll come down to political pressures versus this scientific advice.
Well, on that note, one of the ministers that had opposed the potential new rules was the former Brexit chief David Frost, who quit this weekend. Lizzie, what does that mean for UK-EU relations that the Foreign Secretary is taking on his brief?
Yeah, so Liz Truss, the Foreign Secretary, actually voted to remain in the European Union in the Brexit referendum in 2016, but she's since become a passionate Brexiter. She's an ardent fan of former Prime Minister Margaret Thatcher, both in her embrace of free markets and her disdain now for the European Union. And in her former role as International Trade Secretary, she repeatedly said that the UK's centre of trade gravity should shift away from Europe and towards faster-growing economies in the Asia-Pacific region. So she's unlikely to be a soft touch on Brexit, and it changes the balance of power in Westminster because she's already a Tory party darling and she could be the next contender for Prime Minister.
Lizzie, thank you so much. That's our Lizzie Burden on all things UK. Quick check on these markets. We continue to look at a sell-off across equities. European stocks down more than 2%. We're looking at U.S. futures following suit. Bloomberg Surveillance Edition continues in the next hour. I will be sticking around. Kailey Leinz in New York and Anna Edwards here in London join. All of that next. This is Bloomberg.
We need to believe that we have a Fed that is awake at the wheel.
None of us really want to leave the party too soon. We don't want to miss out.
The U.S. economy is really a super tanker that is still running full steam.
I do think that, again, we're in danger of underestimating at least the short-term economic impact and uncertainty from Omicron.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Monday, December 20th. Our top stories today. President Biden is left empty-handed. He's scrambling to save his policy agenda after a key Senate Democrat rejects his tax and spending plan. Omicron fears ignite a market sell-off. Asian and European stocks are falling. So are US equity futures. Investors concerned about the possibility of more lockdowns. And another record low for the Turkish lira. There's likely to be more of the same after President Erdogan vows to keep cutting interest rates. Welcome to Monday's program, everybody. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards with Danny Berger this morning in London and Kailey Leinz in New York. Matt Miller is off this week. And Kailey, when you look at the market action here in Europe, we're in thin liquidity territory here this time of year, but big moves can still happen in thin liquidity. We certainly have big moves this morning.
Yeah, big moves to the downside for most of the major benchmarks, considering the fact that Joe Manchin said he was a no on the Build Back Better agenda and also weighing the impact of the Omicron variant. We do have some breaking news on that, though, when it comes to Moderna. Anna, Moderna saying their booster increases antibodies 37-fold against Omicron, and you are seeing a reaction to that in pre-market trading. That stock is up about 4.5% before the bell here in the U.S. Now back to the broader markets, though. As I said, broadly a risk-off day. That was evident in Asia overnight. The MSCI Asia Pacific Index actually having its worst day since March. It was down more than 1.8%. And within that, some of the individual benchmarks like the Hang Seng down about 2 full percentage points. One brighter spot was the fact that Chinese banks actually did cut their loan rate for the first time in 20 months, really trying to cut those borrowing costs to shore up the economy. And that translated into iron ore. Futures up about 3.6% in Singapore, a 2-month high, a little bit more optimism maybe around that demand story. And finally, I would note you are seeing a safe haven bid for the Japanese yen. It's stronger against the dollar by about 1/10% at 113.53. Now, here in the U.S., no surprise, equity futures are pointing lower with about 4.5 hours to go until the opening bell. Right now, S&P 500 E-minis down about 1.5%. You're also seeing a bid coming into the Treasury market, a bit of a safe haven bid there, down 3 basis points on the 10-year yield to 137.50. Oil taking it on the chin this morning as a lot of demand concerns are now raised. WTI down about 4%. 67.94 is where we sit. And then, of course, Bitcoin trading in tandem with risk assets pretty much by and large lately, Danny, and it is feeling the heat this morning, down 1.7% to just under $46,000.
Yeah, hard-pressed to find any havens, least of which is cryptocurrency this morning. Kailey, you started with mentioning those Moderna lines. I just do want to point out that some of the losses in Europe, and you can see on Map Markets, go on your terminal, it is red across the screen, but those are starting to ease a bit after, again, this headline that Moderna increasing vaccine effectiveness by 37-fold with a booster. So we did see declines of 2% plus more for most of these regions, but UK, for example, down now by 1.5%, the CAC down 1.5%, but it is still ugly out there. It is still losses of more than 2% for the DAX, for example. And it's interesting that the sell-off really started with a U.S.-based story of Manchin not supporting the Build Back Better program, Goldman cutting its U.S. outlook, but that is extended to Europe, given that it just comes at a very volatile time for these markets when they're dealing with more COVID restrictions. So in the Stock 600, what's on track for its worst decline in about 3 weeks, it's being dragged down by travel and leisure. Now, one of the bright stories today is BNP selling off its Bank of the West. This is a bank that's in the west of the U.S. to BMO, of course, Bank of Montreal. The biggest deal ever for BMO. Even though this is a positive story for BNP, it's only up 0.4%. It really shows us just what an overall drag this macro environment is, that this big deal, this big spinoff that really benefits BNP at a time when they're trying to transform is not enough to carry them higher. We're looking at a bid into havens when it comes to UK bonds as well. We're looking at yields down by nearly 3 basis points. Again, despite a BOE, which is committed to a more hawkish lean. And finally, we, of course, have to flag the lira at another all-time low. President Erdogan over the weekend vowing that he would continue this path of interest rate cuts, saying that it follows suit with the beliefs in Islam. And of course, Anna, in honor of Matt Miller, I have to point out that on our screen, it is green because this is the dollar-lira pair, which of course means the dollar is stronger versus the lira.
Yes, absolutely important detail. Risk aversion writ large then across many asset classes this morning, Danny and Kailey, and that clearly is the dominant theme. That Moderna line just taking the edge off the losses here in Europe, but we do find ourselves still firmly entrenched in the red. Let's get to the week ahead, a briefing of what is to come this week. The EU is expected to announce how natural gas and nuclear energy projects would be classified under its green investment rules, hotly contested in certain countries depending on which of these technologies are relied upon. We'll get the EIA crude oil inventory report. That's coming out on Wednesday, so that's also important to the commodities sector. That will be really timely as the Omicron variant spread threatens the demand picture, as we were just saying, down by more than 3% on the Brent price here in London today. Now, Russian President Vladimir Putin, he'll be holding his annual press conference on Thursday. The key themes are likely to include Russia's standoff with the West over Ukraine, NATO and international relations. And we'll get plenty of data from the United States on Thursday, including durable goods and initial jobless claims. Let's stay stateside then, Kailey, for our first update this morning.
Yeah, that is really where the dominant narrative is this morning. President Joe Biden's economic agenda has been left hanging after Democrat Senator Joe Manchin rejected his key $2 trillion spending package over debt burden concerns. Take a listen.
If I can't go home and explain it to the people of West Virginia, I can't vote for it. And I cannot vote to continue with this piece of legislation. I just can't. This is a no on this legislation.
Anne-Marie Horder, Bloomberg Washington correspondent, joins us now from D.C. Anne-Marie, was that the death knell for President Biden's economic agenda?
Well, it certainly does seem so when you hear Senator Manchin. And remember, the president needs every single Democratic senator to vote for this. He's saying it is a no. And then he released a statement outlining why he got to that decision. He said it was because of COVID, geopolitics, as well as inflation, and that his party wants to remake society, and he cannot go along with that. Now, it definitely does seem to have taken the White House by surprise. Jen Psaki, the press secretary, released a very long statement. She did not mince words, but she ended with, just as Senator Manchin reversed his position on Build Back Better this morning, we will continue to press him to see if he will reverse his position yet again to honor his prior commitments and be true to his word. So the White House is saying that he has not been true to his word. And in this statement, she talked about the fact that Manchin was at the White House on Tuesday outlining what he was comfortable with. So it's definitely heating up. And right now, the legislation as it exists in this moment does seem to be dead. But potentially there is a window of opportunity to scale it back, because what Senator Manchin spoke about on Fox News was that he thought it was the size and scope was too big and not paid for those 10 years. Potentially, if the Democratic Party focuses on just a few priorities, something could be done next year.
So potentially a blow to the Build Back Better bill, but Goldman at the same time downgrading their U.S. GDP forecast for the first quarter by 50%. So how much of a blow is it to the American economy?
Well, Goldman Sachs is saying that it was about a little bit more than even the odds that they thought something would get done, and that's why they had a boost to their forecast. And now it's not just the first quarter they have lowered their forecast; it's the second and third as well. You could see there from 3 to 2.5 and so on. This could potentially be some ammunition for the White House to say, look, a major Wall Street bank is saying that this was going to help boost the economy, and now it's not. Just as the White House left open a little bit of opportunity, potentially hope for Senator Manchin to reverse what he had to say, Goldman Sachs is also saying there are potentially some key priorities, say in manufacturing or supply chains, semiconductors, that potentially something could get done. But right now, it is not looking as a very merry start to this Christmas week for the White House and the Democratic Party.
Yeah, President Biden not necessarily getting the gift he wanted this Christmas. Thank you so much to Bloomberg's Anne-Marie Horder. And some other news out of Washington over the weekend. U.S. Senators Elizabeth Warren and Cory Booker have tested positive for COVID-19. And Jefferies CEO Rich Handler also said he tested positive earlier this month and is approaching his 10th day of isolation. But Anthony Fauci, President Biden's top medical advisor, doesn't expect lockdowns in the U.S. Just take a listen.
I don't foresee the kind of lockdowns that we've seen before, but I certainly see the potential for stress on our hospital system.
Let's get more on this with Sam Fazeli, senior pharmaceuticals analyst for Bloomberg Intelligence. So, Sam, maybe no lockdowns in the U.S., but you definitely are seeing more restrictive measures put into place in Europe, especially some travel restrictions around the U.K. Is the U.S. just barreling toward the trajectory the U.K. is on right now?
Yes, I would be very surprised if the U.S. does not follow the same trajectory. It'll be, I don't know how they would manage that, especially given that this virus, in terms of case and infections, doesn't really care whether you've been vaccinated or not. And booster shots in the US are lagging everywhere else, which are giving you an extra shield to just prevent that infection for at least a couple of months.
Speaking of boosters, good morning to you, Sam. We've got some better news from Moderna this morning saying that their booster increases antibodies 37-fold against Omicron. So adding to our understanding of the ability of the existing vaccines in a third dose to fight Omicron.
Exactly. But Anna, I'm really totally unsurprised by this. This is an active vaccine. You inject it back into people, they raise their antibody levels. So it would have been really odd if this company had reported a much lower level of neutralization against Omicron. But the key question that remains for all of these vaccines is, okay, you give me a boost a week or 2 weeks after an injection of a booster, or a month after the injection of a booster. How long does that last? And what difference does that make to my protection against severe disease? That's what we care about. That's what drives lockdowns when it comes to at least pressure on healthcare systems with regards to the number of people going to hospital. But of course, just last point here, we do have a risk also from healthcare workers contracting the disease. So this would give the healthcare workers some protection, so allow them to continue to work.
All right, a sliver of hope there. Sam, thanks so much. That's Sam Fazeli, senior pharmaceutical analyst for Bloomberg Intelligence. Now, the lira has tumbled to another record low after Turkish President Recep Tayyip Erdogan pledged to cut interest rates yet again, referring to Islamic teachings as a basis for the policy push. Let's get more with Bloomberg's Christine Aquino. Christine, this isn't a necessarily new stance from Erdogan. We've heard him say multiple times he wants to aggressively cut rates. So why is this time different?
Well, Danny, I think this very much clashes with what we heard from the central bank last week, because although they delivered their fourth straight interest rate cut last week, they also indicated that that was the end of the easing cycle. And we saw that that gave the lira and lira investors a little bit of short-term relief in the moment, because they were finally seeing the end to the rate cuts that have contributed to the lira's decline this year. But now, fresh comments from Erdogan really do a number on those comments and kind of mark a bit of a reversal, and making it really clear where Erdogan stands when it comes to rates, that he really wants lower interest rates, and therefore that would make it much difficult for the central bank to go against that and to hold true to what they said last week, which is that they were going to end the easing cycle for now.
Christine, elsewhere in EM, also some news we need to touch on out of Chile. The leftist candidate Gabriel Boric has won the presidential election. What are the economic and market implications of that?
Well, Kailey, I think the initial expectation from a lot of market participants is that this could be potentially negative for Chile's assets, especially because of his very large mandate and victory in the election that gives him a stronger ability to push for some of the reforms, such as higher taxes and greener industries and greater equality. And of course, all of these are being interpreted by markets as not necessarily.
All right, it looks like Christine Aquino is having a little bit of trouble with the connection, but thank you so much for joining us, of course, one of our Bloomberg Markets reporters. And speaking of the markets, let's get back to the U.S. equity markets and take a look at some stocks moving in pre-market trading here in the U.S. Of course, we have to talk about vaccines as we're talking about the Omicron variant. We got that news out of Moderna that the booster shot increases protection against Omicron 37-fold, and you are seeing a reaction in pre-market trading, even though some, like Sam Fazeli, may be slightly skeptical of that news, up 6.5% in early hours. Also moving to the upside, stay-at-home plays. Maybe no surprises. You're starting to see more of the world pivoting toward work from home as we do see this fourth wave of the virus. Zoom, for example, is up 1.6%. But to the downside, basically anything in the travel complex. A lot of concerns about restriction, how this may impact holiday travel. And as a result, the likes of Norwegian Cruise Lines down the better part of 4% before the bell, Anna.
Yeah, we're seeing a lot of work from home at the moment, aren't we? Kailey, you wonder how much of that is because of real fear of the virus and how much of that is people just don't want to spend the festive season by themselves. Right, coming up on this programme, another surprise from gold. We'll discuss how the metal is likely to perform. We'll speak to our colleague Eddie van der Veld about that, plus the 2022 outlook from Art Hogan of National Securities and a breakout year for digital assets. More on crypto ahead. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger with Anna Edwards in London and Kailey Leinz in New York. I want to kick things off with a chart that usually gives us an idea of where the economy is going and therefore where rates are going. I want to welcome our radio listeners as well. I'll explain the chart I have up here. I have two lines that historically track each other very well. One is the spread between copper and gold. That's the yellow line for those that can see the chart. The idea being that when copper is strengthening, there's more optimism about growth, vice versa, when gold is outperforming. And this really tracks the 10-year yields very well, again, as this read on the economy. So copper to start the year did very well versus gold, but now both this ratio and the U.S. 10-year yield has stalled out, trading in a range for pretty much all of the third quarter. But Goldman Sachs has downgraded their growth outlook. There's fear of Omicron spreading. So what does that mean for this continuation of a range, that ratio that has been in a range? Well, let's bring in Eddie Vanderwalt of Bloomberg M Live to help us try to solve this puzzle. Eddie, with this concern over growth, are expectations now that we'll see gold break out?
You know, Danny, I absolutely love that chart, and I'm stealing it later for the Markets Live blog. I can tell you that much. So listen, there's actually quite a strong bearish consensus for gold at the moment. I think there are analysts seeing it drop as far as 1,500 next year, and I think that's on the expectation of higher real rates. The Fed, the BOE, everybody's talking about tightening policy, and I think as that comes to fruition, gold should come under pressure. And the biggest risk factor for gold is that it's got a lot of metal sitting in exchange-traded funds, something like 3,000 tons. That metal, when it starts coming back to the market, that's about a year's worth of mine supply. That could substantially weigh on the metal as we go into next year.
Okay, so we watch that on the downside then, Eddie. Good morning. When it comes to gold, let me ask you about other havens, because on a day like today, when we're seeing such heavy selling here in European equities, down by 1.7% right now, pared the losses a little bit, but still substantial selling, you might expect to see money going into the yen and into the dollar. Money was into the yen earlier. That's wound back a little, but we see more money going into the euro. And this reminds me of the day after Thanksgiving. Is it all still to do with market positioning? Why is the euro behaving like this haven recently?
Very odd one, because particularly if we see the euro, outperform at this stage, then it feels like the market is almost questioning whether the Fed will be able to tighten as much as it says it will, and whether the ECB, will be able to keep monetary policy as loose as it will. But for the moment, yes, I think that's just the surprise that we're having to deal with. But I think it's about positioning, it's about year end, it's about all of those factors. But I will know that this is getting serious when we see that dollar bid. The fact that we're not seeing that dollar bid tells me that the market is quite sanguine still about the moves that we're seeing.
Okay, Eddie, good to get your perspective. Eddie Vanderwelt of Bloomberg Markets Live, dialing back our nervousness and our anxiety, perhaps, over some of this selling we're seeing for risk assets today. For more market analysis, check out MLIV Go. That is the function to use on your terminal. You'll get all the thoughts from the Markets Live team, Eddie and co. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz in New York with Anna Edwards and Danny Berger in London. Now let's get the first word news. And Bank of Montreal is spending billions to expand its presence in key U.S. growth markets. It's agreed to pay $16.3 billion to buy BNP Paribas' Bank of the West unit. That should add 1.8 million customers when the deal closes next year. And BNP Paribas plans to return some of the cash to shareholders through a buyback. In China, banks have lowered borrowing costs for the first time in 20 months. That foreshadows more monetary support to an economy showing strain from a property slump, weak private consumption, and virus outbreaks. According to the People's Bank of China, the one-year prime loan rate has been set at 3.8%. In Germany, the new coalition government has picked former Bundesbank senior official Joachim Nagel to be the next chief of the central bank. Nagel succeeds Jens Weidmann, who leaves at the end of the year. The choice of a Bundesbank veteran would suggest continuity rather than change. Nagel is seen as being close to Chancellor Olaf Scholz's Social Democrats. And Elon Musk says he'll pay more than $11 billion in taxes this year. That could be a record payment to the U.S. Internal Revenue Service. The world's richest person and Tesla CEO has been selling millions of shares to cover taxes relating to his exercise of Tesla stock options. And Danny, you know, at face value, $11 billion sounds like a lot of money, but it's kind of a drop in the bucket when your net worth is something like $240 billion.
Exactly. When you're the world's richest person, that doesn't seem too bad. And of course, the person of the year as well.
Absolutely. I was wondering whether he heard he was in the running for person of the year, then decided he'd better pay a bit more tax just to make sure he gets that particular nomination. I'm sure that had nothing to do with it. I just wonder what he's going to ask Twitter next, if this is how he's going to go about his decision making. Really interesting to see what question he poses to the Twitter sphere over the holiday period or into the new year. Right, coming up on this program, Art Hogan, Chief Market Strategist at National Securities Corporation. We'll ask him about the risk-off sentiment. We talked to Eddie van der Veld of the Markets Live blog. He said he'll know that the market is taking this risk-off sentiment really seriously when he starts to see the dollar bid. The dollar is not bid today, so are we making too much of this negativity? We'll talk to Art next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards with Danny Berger in London, Kailey Leinz in New York. Matt Miller is off today. And Danny, really interesting developments in markets, in European equity markets this morning. We're off our lows this morning, and some of that came before we got that news from Moderna, but that moved to the upside, really invigorated by that Moderna news flow. But we are still underwater, down by 1.5% on the stock 600.
Right. Well, it just does go to show that the sell-off we're seeing today isn't necessarily just tied to Senator Joe Manchin seemingly rejecting the Build Back Better bill. There is an element here that it comes at just a very bad time when we're grappling with rising COVID cases, and also brings into question, will there be more U.S. stimulus if there is bad case counts, considering Joe Manchin has an issue with debt load right now?
Right, yeah. I mean, these two headwinds then weighing on the European equity session. And Kailey, there really is nowhere to hide. When you look at the sector breakdown here in Europe, we have all of the sectors in negative territory, even the more defensive ones. What do you see in the U.S. markets?
It's deeply negative as well, and it does look like we will be set for a negative open come the opening bell in about 4 hours' time. As you indicated, as in Europe, they're off session lows. We are off session lows when it comes to S&P 500 futures, but still pretty deeply in negative territory, down 1.3%. And of course, while you are seeing people coming out of equities, they are seeking haven in Treasury bonds, down 2 basis points on the 10-year Treasury yield, so also off of session lows, but still down 2 basis points. 138.17 is where we sit. And then, of course, speaking of risk assets selling off, crude really getting hit today. A lot of demand questions around the Omicron variant. WTI is down the better part of 4 percentage points right now, trading at 68.07 a barrel. And no surprise, with oil lower, you are seeing a subsequent move in energy-related equities in pre-market trading here in the U.S. The likes of Occidental and Devon, some of the biggest underperformers in pre-market trading, down around 4% each. You're also seeing a lot of the travel complex under pressure. Just one example is Carnival Cruise Lines, down 3.4%. And then you were both referring to the Moderna story. Its booster shot looks like it increases protection against the Omicron variant 37-fold. And as a result, you are seeing a bid coming into those shares. So there are some positive stories going on in equities this morning, Danny, up 6.3% in early hours.
Well, thank goodness for that. A little bit of a bright spot there. But Kailey, really to what large degree is also pulling down markets today is that we're getting these risks coming in. At the same time, it looks like we're having a Fed that's no longer going to be as accommodative to markets. Is that Powell put still intact? So I want to bring a chart to our attention. For our radio listeners, this is a chart of U.S. household equity exposure. In other words, what percentage of their wealth is tied up in equities? At the moment, we've seen it rise to about 62%. This surpasses easily the peak of the dot-com bubble. So that really poses the question, if Powell is looking at a market sell-off and the potential wealth destruction that might come from that, does he then act differently? Well, let's bring this to Art Hogan, Chief Market Strategist at National Securities, who joins us now. Art, good morning to you. Thanks so much for joining us. Does Powell need to act more aggressively against a market sell-off, again, given that many Americans' wealth is tied up in the stock market?
Yeah, Danny, great question. I think that when you look at the percentage of U.S. households that have exposure to the equity markets, it's certainly rising, but I think the value of that is rising as the market has done much better over the course of the last 18 months. So I think that's one piece of it. I think what the Fed is really trying to message to us is that, hey, we're not going to let this inflation get in front of us, and the need for emergency monetary policy is likely in the rearview mirror. So I think the only change the Fed has really made is admitting that the inflation scenario is no longer transitory, or at least that's not the term they're going to use for it, and that they don't need to be buying assets on a monthly basis. So winding that down and raising rates, as far as the Fed's concerned, are two different things. And I think that the Fed will tread lightly before they make the first move on tightening. But removing emergency level accommodation is certainly the right thing for the Fed to be doing in the environment that we're in.
Okay, good morning to you, Art. So, the Fed trying to put distance between those two policy decisions around winding back stimulus, the bond buying and the interest rate hikes. Does what we've heard around the fiscal side of things, the fact that it's going to be more difficult for Build Back Better to be passed, for that fiscal stimulus to push into the U.S. economy, if that becomes more difficult, does that have an impact on how quickly we get to Fed rate hikes?
Well, what's interesting about the second fiscal stimulus package is that the consensus really had been that this is going to be something that gets pushed into next year, and we've already seen it be cut in half in terms of its size. So, in terms of the market reacting or overreacting to what Joe Manchin came out and said over the weekend, I think is just an offshoot of a reason for investors to be taking some risk off the table. We're certainly in a risk-off mode right now. We have been for a couple of weeks, and whatever the latest headline is going to be, we're going to try to attach that narrative to what's going on in markets right now, unless and until we get to a place where people are comfortable with a combination of a Fed that's less friendly to markets of late, and that's only 2.5 weeks old. And the second thing is just getting our arms wrapped around what this latest variant might bring to us in terms of an economic slowdown in its wake. We would suggest that with each new variant and each new wave of COVID case discovery, we've seen a diminishing economic impact. I think that'll be the case here, but right now when we're in the throes of it and we hear about just how fast this thing is spreading, I think market participants get nervous. We were at or near all-time highs 2 weeks ago when we started selling off. So I think that what we're seeing right now in the market is just the natural reaction and likely overreaction to those two things: a tighter Fed and a new variant that we don't know enough about.
A likely overreaction, then, you say. Do you think then that it is an overreaction that we're seeing in markets this morning, Art, around the U.S. fiscal story, or is it very much driven by Omicron? I mean, it's both, perhaps, and difficult to tell. Or is it just that we're in, low liquidity? It's that kind of time of year?
100% of the combination of all those things. So, remember the day after Thanksgiving and how violently we sold off. That was one of those. That's the exact description of what that was. We got a couple pieces of bad news, or at least a new piece of bad news, and a lack of liquidity. I think the same thing will likely be true this week. I think that the participation as the week wears on continues to slow down, and that tends to add to volatility. But I certainly think if the things that we're concerned about is this latest variant, perhaps not getting another fiscal stimulus bill, and certainly a tighter Fed, if that's it, if that's the totality of what we're concerned about right now, we've already overreacted, and this morning is just more of that. I think that investors will likely see that, as time wears on here, that we've overshot to the downside and things are starting to get stretched.
So maybe the equity market has overreacted to some of the risks here, Art. Is the bond market as well, given that the 10-year yield is sub 140 in the face of a more hawkish Fed, persistently high inflation? Is that just a haven bid?
That's such a great question, and it really is. To your point, money's coming out of equities, and it goes to that safety bid. And the move on the 10-year makes no sense in the face of a Fed that's likely going to be raising rates at some point in 2022. I think we spent most of the year in a 1.25 or 1.75 range. On the 10-year, the average is about 1.5. To be down with a 130 handle right now just doesn't make a great deal of sense, except for the fact that that's where the flow of funds are going. That can reverse itself pretty quickly as soon as we sort of shift the narrative around the risk-off mode that we seem to be in, wrapped around the collision between a Fed that's modestly more hawkish and a new variant. And it wouldn't take much to shift that news. And my guess is that we will race back up to that average of 1.5, probably before the end of the year.
Oh, okay, that's a call. There's only a few trading days left of the year. Art. So if that does happen, would you expect to see that show up in growth equities in particular?
Well, it's interesting because we've done a lot of damage under the hood to growth equities when you think about the NASDAQ, which is, call it 5 to 6% off its all-time high or 52-week high. and the average stock in the Nasdaq's down some 40%. So we've actually done a massive amount of damage to the multiples on growth stocks in general. Not to say that that is done. A rising interest rate environment is certainly going to affect the math you calculate for net present value for some of these growth names, especially the names that are just, with profitability out in the future at some point in time, but are just being measured on a multiple to sales. But when you look at the average stock in the Nasdaq, it's down a whole lot more than the index is. So I'm not sure that you need to do a whole lot more to technology or growth or the fast-growing momentum names at this juncture. I think we've done a great deal of damage.
Well, if that's perhaps some of the shorter-term outlook, Art, I know your outlook for year-end 2022 is 5,300 on the S&P 500, about a 15% gain from where we're at currently. So what would you say to the likes, for example, of Mike Wilson over at Morgan Stanley, who expects a decline of 5% into year-end 2022?
Yeah, interesting call, and I think that a lot of that has predicated. Mike's done some great work, and always does, but that he'd also been looking for a 10 to 20% correction this year, which we really never accomplished. So I think when he looks at the world, he sees that as two things happening: not as much earnings growth and a multiple contraction. Both of those things happening at the same time typically don't, right? So to me, I think we're not going to see a multiple expansion, but I certainly think we're going to see earnings growth. I think we've got an elongated economic cycle because of the supply disruptions and demand that hasn't been satiated for both goods and services. So I think that as we put the Omicron variant behind us, we're going to start looking at things that we weren't able to do this year and start doing them next year in terms of consumption, travel, and leisure, and certainly getting out and about, and that reopening trade probably reignites. But I think you need to be balanced next year between a combination of both growth and economically sensitive cyclicals.
I think we all look forward to the day where the Omicron variant is behind us. Thank you so much to Art Hogan, Chief Market Strategist at National Securities, waking up early for us this morning. And coming up, cryptocurrencies had a breakout year in 2021, adding $1.5 trillion in market value. We'll take stock of the year in crypto and what's ahead next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, American Action Forum President Douglas Holtz-Eakin. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger alongside Anna Edwards in London and Kailey Leinz in New York. Now let's turn to cryptocurrencies, which have swung wildly throughout the year and added some $1.5 trillion in overall market value along the way. Bitcoin, up more than 60% this year, absorbed much of the attention, but had to share more of the limelight with the likes of Ether, as well as meme tokens such as Dogecoin and Shiba Inu. Mike McGlone, Bloomberg Intelligence Commodities and Cryptocurrency Strategist, joins us now from Miami. Mike, we look at crypto continuing to triple more or less in the past year. As we look at the forward trajectory, how much of it will continue to be Bitcoin growth versus some of these other cryptocurrencies?
Danny, thank you. I think that was a great lead-in. I think it's more, Bitcoin was kind of disappointing this year, but looking forward, we're in a mode that if you're long risk assets, you're fighting the Fed, and crypto is among the riskiest assets. You mentioned Ethereum and then Shiba Inu and Doge. I think all those assets are going to have a problem going forward, most notably if you have days like today. But Bitcoin should be one of the best performers, i.e. today, yes, it's down a little bit, but it's down much less than crude oil. It's down about the same as much as the stock market, yet has a similar risk and volatility. So I think looking forward, we're going to see that global reserve asset becoming collateral, and Bitcoin is, it's replacing gold and it's doing well with long bonds, and the rest of the space fighting the Fed and fighting this return of the virus that won't go away.
Yeah, it's so interesting you bring up this point of not fighting the Fed. It impacts risk assets, and crypto obviously being one of them. But does that mean in the months ahead, as we look at a Fed that ups the pace of bond buying, that starts to tighten, that this will be a very volatile period for cryptocurrency? Can we put that in context of the degree of volatility versus what we've seen over the past few weeks?
Well, the key thing to remember about Bitcoin, its volatility relative to the overall market's been declining over time. Most notably, if you compare it versus gold or versus the stock market. I expect that to continue because what's happening is the world's getting off zero and they're getting into Bitcoin. They all know the stock market's overdone and the Fed's going to focus on that. So maybe we'll get lucky and we'll get tightening next year, because you know what tightening means? It means the stock market didn't drop. And we know what's going to happen. The stock market, the Fed's just going to jawbone and the stock market goes down. So I see Bitcoin coming out the best. But the key thing to remember about Ethereum is it's part of that revolution in crypto dollars. People call them stable coins, but the vast majority track dollars, and they're all based on the Ethereum token. And then we have NFTs, basically digital property rights. They're denominated in Ethereum. So looking forward, I think it's more of a normalization. The Shiba Inus and the Doges are going to just get pushed away. I mean, there's speculative excesses, signs of it. And Bitcoin and Ethereum should continue to march higher. So I'll end with this. It's the three musketeers should continue. Bitcoin, Ethereum, and the proliferation of crypto dollars.
Okay, we'll look to the three musketeers. Good morning to you, Mike. You say that Bitcoin is going to replace gold, and I know that you've had that view for a while. But some parts of the world where gold's really popular, they're trying to ban crypto. I mean, I'm thinking of India, for example. How do you think that it can replace gold if it's going to be banned in certain places?
Oh, it's good lessons of English history. When you ban books, they just go off the charts with selling. People just want to buy it. So once you ban something, it just indicates how valuable it is. Now, they've been banned in China, so that's how we have that major dichotomy between the Western world launching ETFs and futures and embracing it, and some of the, like China and maybe India, banning. So I think what's happening, the fact is, Bitcoin is replacing gold in a lot of investment portfolios, and you have to look forward, is that trend going to change? I fully expect it's going to accelerate, so it's really not that profound. What trips it up? I don't know. Bitcoin is the world's most significant global digital asset in a world going digital.
Okay, it is trading down, as you acknowledged, Mike, today, as we see other risk assets move lower, down by 1.6% on Bitcoin. But there's more to crypto than just Bitcoin, as Mike points out. Mike McGlone, thank you very much for joining us from Bloomberg Intelligence. Coming up on this programme, a banner year for M&A. We'll dig into some of the world's biggest deals, including one confirmed just this morning. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards with Danny Berger in London and Kailey Leinz in New York. Now, Bank of Montreal agreed to buy BNP Paribas' Bank of the West unit for $16.3 billion. This is following a record year for global M&A deals. Let's get a briefing then from Bloomberg's Fareed Salool, who joins us this morning. Fareed, great to have you with us. So, I mean, this is just today's deal, but there have been so many, and the numbers we're talking about are so big. What is driving then the rapid pace of deal making that we've seen in 2021?
Morning, Anna. Well, it's a number of factors, really. I remember this time last year we did a story saying it had been the biggest holiday period for deal makers on record, and that pace has continued right up until today, as you said, with the deal by BMO to buy BNP's US business. The factors are multiple. The main ones are, cheap financing, super acquisitive private equity firms. You also have, strong valuations in the equity markets, which has given CEOs the confidence and, crucially, the firepower to pursue deals. And, add on to that things like you've got sparky activists, causing trouble at companies, forcing them to kind of look to spin out, carve out certain assets, and companies even off their own back trying to do that. It's all just it's coming together to drive us towards this $5 trillion year.
Okay, yes, you mentioned the low interest rate or the cheap costs of financing for these kind of deals, Fareed. It's interesting how we seem to use that when we use that as a reason for seeing high deal volumes at a time when interest rates are low, but then we also seem to be able to apply it as interest rates rise, because then there is a fear that if you don't buy it today, it'll be more expensive tomorrow. Is that what lies in store? Is that one of the things that will continue to drive deal volumes in 2022 then?
Well, of course, we saw the Bank of England raise rates last week, and there's expectations that the Fed might follow in early 2022. I mean, yes, that's something that's often cited as a concern for deal makers. Although at the moment, I think that the ones that our team's been speaking to are pretty confident that things are going to continue, in no small part because of that point I mentioned earlier about private equity firms. They are, they're sitting on huge amounts of cash. They're raising constantly ever bigger funds. We've got numbers, names in the market like Carlyle, Permira, Cinven, all looking to raise new money, and the deals that they're chasing in that kind of $1 to $10 billion bracket have been the lifeblood of this boom, and I think bankers expect that to continue going into 2022.
Yeah, as you say, some absolute monster-sized funds that they're looking at raising. I do also wonder, Fareed, to what extent activists have been really pushing a lot of the deals, considering a lot of the deals we've seen, for example, are spin-offs from existing companies.
Yeah. Yeah, activism is definitely something that's fueling this. I think there was an initial kind of tail-off in campaigns as the first COVID wave hit. I think they were willing to give the companies a little bit of a pass as they kind of tried to steady their ships. But as the economic backdrop has improved, and activists are back on the scene. We've seen the likes of your household names, your Elliots and whatnot, pushing for change at companies like GSK. But now you've got these little plucky upstarts like Bluebell, which is also weighing in at companies, including GSK and I think more recently Glencore. And again, the expectation from the deal makers that we speak with is that these guys are going to be here now, going to be making some noise and pushing companies to create value through sales, and that means more M&A.
Fareed, fantastic reporting. Thanks so much for joining us today. That's Bloomberg's Fareed Salal. Now, let's take a look at what else we're watching today. And I'm continuing to look at the happenings in Turkey. We look at the lira that continues to slide to a record low, and it's trading just below the $18 mark versus the U.S. dollar. It comes as Erdogan over the weekend said that he's going to continue to demand lower rates, that Islam demands it. But it will be especially interesting to see how the business community responds, because they've been very critical of this. They've said that they want him to adopt more orthodox policies, and obviously he's hitting back out at them, saying that this isn't the way forward. This isn't, again, in line with Islam, how they should be acting.
Yeah, interesting to see that increasingly outspoken business community and coming out in public and saying these things. Also interesting that we had seen some stability assumed by some commentators around the lira, given that the central bank has said they'd come to the end of their rate cutting, but clearly the power lies here with the very vocal president who has a lot to say on this, and he has certainly made his thinking clear. I'm watching COVID restrictions across Europe because we clearly learnt a lot about this over the weekend. The Netherlands going into what is, by any standards, a pretty hard lockdown. Here in the UK, no plans for that at the moment. We heard the health minister, though, not ruling out further restrictions, even coming before Christmas, maybe after, maybe into the new year. But we'll continue to watch what's going on in the UK context. Germany considering vaccine mandates, of course. France curbing nightlife around New Year's Eve. So sorry for anyone with Paris party plans. They may extend use of COVID passes as well. And Italy on Thursday, they're going to be holding an emergency meeting and reviewing the extent to which they've got the right policies in place. Of course, another interesting point of discussion is the contrast with the US, where Anthony Fauci is saying, he doesn't see lockdowns in the short term.
Right. And of course, Moderna boosters helping out against Omicron, 37-fold. So we'll see if that changes the conversation as well.
Absolutely. That's an important point. And not a surprise to Sam Fazeli, he tells us, but still reassuring enough to provide a bit of an up boost for European stock markets this morning. More Bloomberg Surveillance is ahead. This is Bloomberg.